Good afternoon, ladies and gentlemen. I'm Bill Clifford, President and CEO of the World Affairs Councils of America, and I'm delighted to bring to you this conversation about the future of money and banking with the CEO of Bank of America, Brian Moynihan. At the outset, I just want to apologize to those of you who have joined at 4 o'clock that we've been having some technical difficulties on the back end with our Zoom, but Brian is here, as you can see, and he will be talking with Tanea Makil, who is a business journalist based in New York City, who covers consumer banking and finance and the future of money. We are in phase 3 of today's programming of Conversations of the C-Suite, Powering Global Recovery and Change. 3 CEOs today are presented who are from the health, technology, and now the financial sector, all Fortune 500 companies, all terrific leaders. And we'll get to the conversation in 1 minute after I introduce Brian Moynihan. He is CEO and leads a team of more than 200,000 employees dedicated to making financial lives better for people, companies, and institutional investors across the United States and the world. Brian joined Fleet Boston Bank back in 1993 as Deputy General Counsel and rose through Fleet and also Bank of America through a merger in 2004 as head of global wealth management. In 2008, September, in the heart of the financial crisis, really, Merrill Lynch, as you recall, was sold to Bank of America, and at that time, he was CEO of Merrill Lynch. When Ken Lewis stepped down as CEO of Bank of America in 2010, Brian took over. That was 10 years ago. This year, he was named Chief Executive Magazine's CEO of the Year for 2020. Brian participates in several organizations that focus on economic and market trends. These include the World Economic Forum's World Institute Forum, as well as the Federal Advisory Council of the Federal Reserve Board. Brian also runs Bank of America's Global Diversity and Inclusion Council, which will be an important topic of our discussion today. Now, Tanea Makil, as I mentioned, is a business journalist in New York. She was an on-air reporter for Cheddar for 2 years, where she anchored its weekly cryptocurrency show, The Crypto Craze. Prior to that, she covered the intersection of banking and technology at American Banker and Digiday after 2 years as a reporter at CoinDesk. You, the audience, will be able to join this conversation in 30 minutes using the chat box of your YouTube Live. Please send your questions to us, and we will make sure that Tanea poses them to Brian. But right now, Tanea, I'm handing it over to you to ask questions of your own. Thank you both for joining us.
Thank you so much, Bill and the World Affairs Councils of America. This is very exciting for me. Thank you so much, Brian, for being here today. Actually, my very first question is just, how has it been going for you? It's been such a crazy 6 months for everyone. How are you?
We're doing fine here. The company's doing well. The family's safe. Hopefully your family's safe also. It's never forget this is a healthcare crisis, and that's what we all have to focus on, in a human crisis. And we can talk about business and economics, but we got to remember that's what the heart of this is. And so we got to keep keeping everybody safe and trying to get through it.
I couldn't agree more, and I'm so glad you said that. And Bank of America, I mean, this is beyond Bank of America. So many companies, including you guys, have overcome so many challenges in the last few months with regard to the healthcare crisis of it. Moving to remote work comes to mind, keeping all of your employees safe and healthy. So what would you say is one of the biggest challenges that you guys have overcome, and what is something that is still a challenge to you that you guys are working on?
Well, obviously, in the end of the day, we had to respond to the crisis, and we're a global company, so we had people who were in Asia that went into the crisis earlier, and then it moved around the world. But the key was in mid-March, when the markets were melting down, we simultaneously had to move 100,000+ teammates to work from home, and equip them with computers. And some of these teammates never have worked from home before. If we have a storm come through and we shut down the call centers in Jacksonville, those people went home. We picked up the volume elsewhere, and a few days later they would come back. And after you got through all the work, it was just different that everybody won at once. And so 100,000 computers, 100,000 screens, people who had never worked in that environment, getting up to speed, taking the high-risk teammates off the line, so because they were going to be more highly affected by the disease, and then taking them from job A and putting them in job B over 6 or 8 weeks. So just that physical move, while at the same time, we had $275 billion of the deposits come on the company's balance sheet. We made $90 billion of loans, or 80 billion or something like that. We did the whole PPP process on work from home, 10,000 people working in the high points to get that done. So just think of all that activity going on in a very unusual environment that had never occurred. And yet the team did a wonderful job, and we were there for our clients and our customers, and we were able to get through the stuff. But the one group that people forget about in the bank is we have the teammates that work in the branches. In the branches, we brought some of them down, the numbers down, because of the demands were down, obviously, but also to keep our teammates safe. But we had 20,000 people working in the branches every day who never were from home and were facing the public and helped keep the public in the cash and money and the things they needed to work with. And those teammates did a fantastic job. So that was the biggest challenge, of just getting through that. Well, it wasn't a calm, quiet time. It was a very turbulent time in the markets. That still remains a challenge, because we've got a few things ahead of us. We've got elections, we've got Brexit, we've got the resolution of this virus, and we've got an economic elements that happen in the second quarter, the recovery in the third quarter, and we'll see where it goes next. So that's still the challenge, is how to operate in this very unique environment with keeping your eye on the ball, keep the teammates safe, keep the clients serviced, and keep working to make some money for the shareholders at the same time.
There's a lot going on. You went on CNBC last week, and you spoke about the need for another more narrowly defined round of stimulus that would be aimed at the 8% of Americans who are still unemployed. And the thing I've been thinking about is, with the PPP loans, so between the loan forgiveness terms for the Paycheck Protection Program, which is that 75% of the loan be spent on employee paychecks, between that and the extra pandemic assistance that's coming for people on top of their unemployment checks, for a lot of people, particularly in the service industry, and you had mentioned the restaurants in Midtown are not reopened yet. For a lot of people, they're more incentivized to stay unemployed and collect more than they would make at work in a pandemic. So I guess my question is, how could another round of PPP or another round of stimulus be improved? What should our policymakers be thinking about?
Yeah, as I talk about this or think about it, you think about, let's just talk about two businesses. Your dentist and the rest of your favorite restaurant. Your dentist shut down because of the requirements, and then it's now open, and you probably can't get an appointment. They're so busy. And so, that they don't really need a round of PPP or anything. They're back to full operations. They may have had some expenditures they didn't plan to have to change their office. They may have had some things done. But now let's talk about your restaurant. It's open outside. It's getting to winter. It's going to need help if we want that restaurant to be there when the world normalizes. And so that's what I mean by targeting. And so I think there's $100+ billion in the first PP funding that was not spent that could be sort of rolled into another round with a vote. So that's the question. If you think about the performing arts venues, the great theaters in New York, or the great Jazz at Lincoln Center, whatever it is, and all around the country, and this is not unique to New York, and just think about the question of, until they open, if we want them to be there, we're going to have to help them get across that bridge to the other side of the river. So that's what I mean by tailoring. So it's performance venues and restaurants, and then the big industries, the airlines and travel industry more generally, hotels and things. How do you help those people by giving them either PPP loans if they're smaller, or other assistance, so they can continue to maintain their employee base? Frankly, if you're going to supplement the unemployment stuff, the government's going to support the individual one way. The other way, you'd rather have them stay in place and be ready to work. And so I think that was the theory of the original PPP. It worked well. So I think we could roll that over. We could do some more help with the states, universities, and others that have massive expenditures to deal with the virus. Those are the places. But you can tailor it, I think. And we'll let the policymakers decide how big or small that is. But the principles, I think, of tailoring it and focusing it are good, because then you can take less dollars and make them do more.
You said the phrase, when the world normalizes. Do you have an inkling or a personal prediction on when you think it might normalize or become a new normal?
Well, that's an interesting question, because it's normalized now in a way, in a sense that the money spent by the customer base, the consumer customer base of Bank of America, basically spends $3 trillion a year round numbers. And whether it's debit and credit card spending, wires, ACH, which is sending out through that cash out of the ATM, checks written, Zelle, whatever form, it's 3 trillion. That is actually running about 5% in the month of September or whatever in last year, 5-6%. Year to date, it's actually flat to last year. In other words, it's as big as it was last year. So there's been some normalization. People are spending money on other things. When I talk about normalization, it's the ability of a person to get up, commute to work, go to a building, work, do what they would normally do, and go home. A kid to go to school. Those are happening. That is, again, a healthcare crisis, a question, not a economic question. And I think, what the good news is, as you're watching the travel of the virus and the precautions people are taking, the mask and stuff, the infection rate and stuff is kicked up a little bit, and there's great concern. But leaving all that aside, the reality is that the hospitals aren't overwhelmed. The treatment regimens are better. It's still not good if you have comorbidities, so you have to watch high-risk people. And so there's some normalization going on. No restaurants open at all, at least open outside. The museums are opening and people are going, less people. The museums are now opening for limited number of people inside. Those things are starting normalization. It isn't going to be there till we get to the other side of the healthcare crisis. But I think people forget the world's an interesting place, and effectively, the people are spending money on other things, but they're spending money. They aren't traveling abroad, but they're traveling, try to get a hotel room and in any environment, not in a major city, and it's pretty tricky.
Okay, well, this session, according to its title, is meant to be about the future of banking and money. For most of my career, covering the future of banking has been all about covering banks' digital transformation and the competition from non-bank startup companies. Banking today, though, is pretty digital for those that have access to it. I mean, I assume that most people who are watching in this audience, they tend to pay with cards instead of cash. And when you access your bank information, I suspect you do so digitally a lot of the time rather than visiting a branch or picking up the phone. And I know that B of A reported pretty positive digital growth in consumer and even more so in global wealth and investment. I looked at your Q2 numbers. What is something that you see as part of the banking experience of the future, or something that should be part of the banking experience of the future that we don't really have yet today, or that we haven't, fully implemented, that has become a normal thing today?
Well, I think, so if you think about, one of the statements is people don't pay with cash. Well, today, $300 million in cash will go out of our ATMs, to give you a sense. So yes, there's a lot of cash still in the system. And so the idea is that people do whatever they want. They're customers, they get to transact however they want. They're writing less checks this year. The numbers are down 10 or 15%, but the balances are only down 5 or 6%, which means they're writing bigger checks. And so you start to sort all this through, and using Zelle's up 100%. So what are the changes in the experience going forward? The integration of high touch and high tech is actually what we drive at. At the time of Bank of America and Nations Bank merged in 1999, the company had 4,800 branches. Today we have 4,300 branches. The total size of the company was $500 billion in size. Then it is 2.4 trillion in size. And so think about how much bigger the company is with less branches. Now, what has driven that? The digitization of activity, the change of activity. So what do we see just on the consumer side? Because that's sort of a little easier for people to see. Think about Erica. Erica is in the hands of 13, 14 million people using it. You can pull up Erica and say pay the energy company, pay.
Can you say what Erica is for anyone that might not know?
It's a digital system. It's embedded in the app, and you go in and it pops up and it gives you insights about your spending. But if you just say tap on Erica, hit the microphone, it says what would you like to do, and you hit the microphone, say pay my electric bill. It'll pull up your electric bill. Do you want to pay this bill? How much, etc. The travel of that forward is going to be the interesting thing, because it is providing both internally and externally. We're using internally the natural language processing capabilities, artificial intelligence, analytical capabilities, the ability to pull data from 110 systems at once through a mobile and get it into a mobile system in real time. This is all built, so now you can start to leverage it. And so the learnings it gets. So if you ask me what changes in the future, is the ability to manage your life with a digital assistant who learns more about you and does it. That's interesting. the digital purchase experience for cars and stuff like that is skyrocketed amount, and it will keep going because it's so much easier. The digital home, we're trying to get it all digitized. So we got the application, you get the loan pretty digital, and then you go to closing and still a pile. Now, how do you digitize that? So there's a lot of experience that you continue to push here. And so we preload in the form, 50, 60, 70% of the information for our customers. Those are great helps. And it's really artificial intelligence combined with data analytics, combined with huge data warehouses that can provide data real time. Because remember, the customer's not waiting for you to fill out the form. They're basically watching it populate. So those 4 or 5 elements of technology driven off the voice recognition platform we have, that's 14 million people, whatever it is today, using it, is a critical element to help drive it. The guts behind it, for lack of a better term, helps us build these other platforms. And so if you said, where does this all go? It's going to be the ability to talk and things happen. And that's, that is the hugely difference in capabilities. The ability to talk and have things happen opens the device up to everybody, no matter how good they are typing on an iPhone, no matter how good they are doing it. But remember, that is very deftly handled because people can't exactly say exactly what they want in the way that we may process it. So we have to have the linkage to make it happen. That's why I think the experience changes. And then the ability to monitor your finances and help you manage your finances, which is embedded in a lot of the automated tools of analytics and pulling in other accounts and automated rebalancing portfolios and wealth management. These are all things that are about a basic principle, which is do it for me in a way I understand it, completely personalized for me, and do it in volume. And do it in ubiquity. Those are the amazing parts of this.
How do you manage there is a major narrative that's out there right now, specifically around conversations about Facebook, data privacy, security. I mean, don't get me wrong. I think certainly most people, even if you're not willing to admit it, would definitely trust their bank a lot more than a company like Facebook, or even, a bigger Silicon Valley giant with not as many reputational issues. But how do you push that product and that future banking experience at a time when a lot of consumers are worried about how companies are using their data and how companies are listening in on their conversations and collecting data on the back end?
We use the data for you. We don't monetize the data outside our relationship with you, and that's a different business model. And I'm not reflecting the other ones, but so all the data we have is used to help you understand what your account looks like, how you're spending money, and you can turn it off or turn it on. But all of it is about you and your data and you and protecting that. And so that's where I think we have tremendous trust from the customers, and we spend hundreds and hundreds, probably $1 billion now, in security defense and things like that to help protect us on that. And data accuracy and storage and delivery, but the basic premise is our data is used for you, and the only person that has it is you and us, and that's the way we've always approached it. We don't sell third-party products, so if you get a mail in the mail, you don't get a statement saying buy this insurance company, you don't get an offer. We have 4 or 5 products we sell to consumers. We have the wealth management products we sell, and the commercial business we have those, and that's it. We sell our products to our customers based on the data, so it's a one-to-one contained relationship.
To what extent does Bank of America pay attention to what non-bank competitors are doing? So specifically fintech startups and what they're building. And I mentioned Facebook, but also, financial services that companies like Facebook, Amazon, Walmart, T-Mobile, those companies are integrating into their existing value propositions. I think Google has a partnership with Citibank to provide consumer bank accounts or something. But as a legacy institutional company, does the competition from others or the pressure to stay ahead ever worry you?
So we look at what everybody is doing to figure out what the customer need they're satisfying and try to figure out whether that means something to us. So coming out of the financial crisis, to think about small business underwriting, we had pulled back and made it more of a process. I think we've gotten out to 20 days for the average turnaround time. And then you started seeing that you got to go back and think about 10, 11, 12. You started to see, the various companies start to pop up, and we took a look at it. And, the way we choose clients we underwrite, how we underwrite them, and the criteria is such that, we might not want to do it instantaneously. That's someone else's business model. But we have all the artificial intelligence engines and data analytic engines, and we've had them for years. I mean, we're in books about how good we were this in a decade ago plus. But the reality is we were taking 20 days and other people taking 20 minutes. And the answer can't be 20 days if other people are 20 minutes. So we retooled the whole process, then go into your digitization point and brought that in. And then, then we started seeing the business grow again. And especially with the clients we choose to work with in terms of credit extension. So, we are the small business lender. We are the biggest small business lender in the United States by a chunk. We are grow that portfolio. We're the biggest small business lender, by a lot and not a little, and we focus on it, but we learn from everybody. So whether it's that or whether it's in the payment area and all the different payment devices and elements that come up from PayPal to Square, and you pick the other ones, we look at them all and figure out what they're doing. And it was a reason why we brought in the merchant transaction processing business back into our company. We had a joint venture. We brought that back in, not because our partner wasn't a good partner, it's because we need to control that to drive the next round of development around how we think about payments in our company. So we study everybody, big, small, mainstream, competitor that's a big bank like us, mid-sized banks, non-banks, foreign things, and we have a team that's constantly looking to think about what we need to do. And we respect them all, but we're pretty good. And we're growing at you start to think about nearly, I think, 40 million mobile digital customers today and growing, and them representing, $800 billion of consumer balances in the wealth management. This is stuff that is growing at a volume that is huge. We'll have 2 billion digital interfaces in the second quarter or something like that, digital connections in the second quarter. I mean, that's the business we have today, and it's growing 10, 15, 20, 30%, depending on the stuff, 70% in Zelle. And so the idea is we study everybody, make sure we're staying ahead of it.
Right. Well, this panel is also about the future of money. So I want to mention that Bitcoin's 200-week moving average and number of consecutive days above $10,000 are both at all-time highs. I have mentioned Facebook. Facebook is working, if you don't already know, with a consortium of companies to create a digital currency called Libra. The Central Bank of China is working on issuing its digital yuan that it hopes could challenge the US dollar's global dominance. And I have to know, what do you make of all of these different initiatives to upgrade cash effectively?
Well, I think, so we sort this question. There's some of the technologies of blockchain and other things that we have tons of patents in. We're one of the largest financial institution patent receiver, and we hit record numbers again this year. So we believe in distributed ledgers and architecture and simplifying things and digital movement. That we also believe in digital movement money. Today, our consumers move probably more like 60% of that $3 trillion I'm talking about all moves digitally.
Wow.
And so this is not, we're not, and so the question then is, what's going on? And they're very different initiatives. All the stuff you rattled off is hugely different stuff, depending on a central bank trying to create a digital representation of their currency. But, they already have digital accounts. I mean, we have hundreds of billions of dollars on the Fed. There's not a bunch of pieces of paper sitting around. It's all digitally implemented. We'll move $2 or $3 trillion a day on the institutional side of the house, all digitally. And so the question is sort of what's the question you're trying to solve, and what you're trying to solve, is the friction in international transactions, the cost of transaction cross-border, especially smaller transactions, ability to have commerce for somebody in Brazil to sell something to you and have it move, and the information move, and the trust move and stuff. So there's a lot of elements to that we are deep into working with ourselves and other industry partners to solve. But one of the big things in the U.S. context was to create, the digital movement through Zelle, and that's an industry-wide platform that already has basically 90% of the 5,000 banks have transacted on it, so it's not a small part of the banking system, and it moves. We're doing record volumes every day. It's growing 100% a year, and what that is that does replace cash movement, because that incremental payment and having Zelle to small business allows money to move for you to a merchant directly, with only them having your email, or you having your email or cell phone number or whatever. Those are
change like sensitive bank account information or anything. Everyone should definitely
they have a directory, directory of basically all the bank accounts in the country, and that stuff's pushing on. So we'll figure all this out, and there'll be multiple factors. But one of the main responsibilities of us is to be able to move money and live up to our responsibilities across the board in terms of safety, security, and AML, and who the customer is. And those are things we take serious. But we are moving huge amounts of digital money on a given day. This isn't theory. This is what moves. By the time we end the day, actually, it's getting the end of the day now. There'll be $2 trillion moving in the commercial business today.
Well, so I mean, Zelle and blockchain technology, that's going to help move dollars. Is it necessary to create whole new currencies? And maybe it's not Bitcoin. I mean, what the Libra Association is trying to create is not necessarily a cryptocurrency, but should the US dollar be under threat? Is there a need to create something new, something synthetic that's within a corporation?
I think you got to divorce the dollar and the store value the dollar is versus the movement of money, which digital, we have to keep pushing that. And so we need the currency to represent value, and because otherwise you get in debates about it. So Bitcoin moving on a given day, the dollar doesn't move like that. I mean, the traders on the floor get really excited when the dollar moves a tiny little bit or something like that. So you want stability in currencies, whether it's the Chinese currency, U.S. currency, U.K. currency, and so these major currencies that major transactions take place. So I think there's different elements here, but I think that the necessity to move cash, coins and currency out of the system it's relentless, but it's still a big task ahead of us, and we have a huge investment in that. Then the second thing is to make sure the underbanked get banked, and we built a set of products that allow people to open transactional bank accounts at really no cost to them, at very little cost. They give them full access to the banking system with every ATM, every branch, everything they get, all the call centers and everything, for $5 a month or $4.99 a month. If they don't maintain a minimum balance, if they have $250 in direct deposits a month, that it's free. And so these are things that we need to do. And then the international small balance movement is something that the industry needs to move faster on, I think. And so there's elements this has, but I think in terms of reserve currency, I leave that to the US dollar and the federal government, because I think it's critical to have currencies that are stable.
All right. A little bit of a gear switch, but sort of going back to the future of banking. And before I get into this, I just want to remind everyone to start putting your questions in, because I'm going to be taking those probably after this question. Brian, one of my favorite interviews I ever did in my career was with Kathy Besant, who is their Chief Technology Officer. And I love listening to her talk about responsible AI. So I thought of this because I'd like to think that advancements in technology and in artificial intelligence are making it easier to regulate and catch discrimination, specifically racial discrimination in lending. But racism is a system we were all born into, and I think personally that technology perpetuates all of our racial biases. So I don't know what the first step is for banks in rooting out racial bias in tech, in lending, but I have to think it starts with employee education and human conversations. So I guess my question is, what responsibility, if any, do you and the leadership at Bank of America have to your employees to educate them on racism and anti-racism?
Well, I think two things. One is this industry is extremely regulated on the question of fair lending. This isn't a new concept. It's been going on for years. So at the zip code level, we're tested on approval rates, on market share questions and things like that. So that's what goes on. So we have built, in a given year, we'll do $5 billion of low and moderate income lending. In a given quarter, 30% of the loans will be to low and moderate income people, and so that's a age-old practice tested for discrimination, literally at the loan level and all the different things, and tested by the regulators, and that's enforced by justice and stuff. So I think that the question then is, how do you open up more access, and how do you have that? So we created a $5 billion special program a couple of years ago. We're $3 billion through it. We'll re-up on that. And these are programs which aid in down payment and speed people to credit faster. But you got to do that in a contained environment, because if people over borrow, it doesn't turn out perfect all the time. And that's the lesson of the financial crisis. When you go to more broadly, we drive a diversity inclusion practice in this company and have for a long point of time, which it really is both diversity, which is representation, inclusion is how people feel. As the issues came up over the last several months, going back to March with the killings and of George Floyd and others, and then the discussion, we accelerate our Courageous Conversation platform. This is a platform we've had going for 4 or 5 years in the company, and in those conversations, about 168,000 people have been in a courageous conversation in groups of 10, 15 people about race, about differences, about what it's like to be. One of them is called Driving While Black, for example. So what the difference between my child driving a car and one of my colleagues' child's driving a car and getting stopped by a policeman, how that feels, even for the people themselves. Parenting questions, just in real raw dialogue. And Tom Montag's been a leader, bringing in outsiders to talk about this. When the issues came up and the teammates asked us what we were going to do, we had basically 3 components. One is, when was basically denouncing racism in any form. Second was our $1 billion program that we put on the table which was already in development, and then we just accelerated it for racial and social justice. The third element is we seeded a gift to the Smithsonian to create a national platform on courageous conversations about race. I've been on the board of the African American History Museum, History and Culture Museum for about a decade. Lonnie Bunch, now runs the whole Smithsonian. He ran that, just watching that for the last decade, learning from my colleagues. Basically, I see the need to have this conversation, and a lot of our teammates said, I have this conversation in the company. I don't find on around, and can we help? And that's where we started with this seed gift to get that conversation platform going. And so there are tremendous conversations and training and work, but we think of it as 2 basic things. The representation, which statistics, which we tested every single level in the 8 levels in the company. There's 8 levels beyond me in the company. And we tested every level and how it does, male, female. We tested, not only people of color, but subsegments of ethnicity, LGBT, et cetera. And then we go over to the inclusion. And we define inclusion in our company about 18 years ago, probably now. I was the head of Diversity Inclusion Council, and we tried to find out if somebody could define inclusion. And so we tried to find if there's a metric you could use to define it. And so in that process, we had to come up with a definition. And so we went outside and nobody really had a good definition. So we went and just asked teammates, what would you like to be at work? And we had a teammate basically say, what I want from work is to be able to come to work and not have to leave who I am at the door and pick it up on the way home. And we have been defining it that way and driving it that. And we test inclusion through a metric that we actually measure in our social survey every single year. And it's running at all-time high. But it's trying to achieve that I can be who I am and be successful in a company that is important. So our employee networks help us do that. 160, 70,000 people in employee networks. Our courageous conversations, our the whole reward system we have around it. All that is really geared to having this dialogue go deep, which raises awareness of the issues of the day. And they took off a new meaning in the recent environment. And we tried to help our teammates have that conversation at work, and the emails I get from the teammates, literally thousands of them after they've had these conversations. The range is unbelievable. And in terms of, I had one to kick off the platform of the Smithsonian with Lonnie, Mark Morial, and Jana McGree from the Unidos. And so the 3 of them talked about it, and basically we got into these questions about what is not going right? How do we fix it? What should do? What do people feel? Why do you feel different? What's the meaning of Black Lives Matter to the Hispanic community? And those kinds of questions, the questions on people's minds. So you got to have that kind of atmosphere. And we strive to have it. Can we be better? I'm sure, but we strive to have it.
I'm really glad to hear that. I have to skip one of my follow-up questions because we are short on time and I want to get to audience questions. Before I do that, Brian, this is just 10 seconds on this. When do you think you guys are going to have a female CEO? Citi just named Jane Fraser is there next. I think JPM's on track to appoint a female. What is the outlook for B of A?
I told people it's a 50-50 chance because we're 50% women, so we'll see what happens. But I don't talk about my successor because it's not my choice. And my job is to have a bunch of talented teammates ready to go. And And so, and I always ask when people ask me that, are you trying to throw me out of here? So if you're not trying to throw me out, I've got a good run ahead of me. And when we get there, the board will make a decision based on a set of teammates, which are very diverse, that are in front of them to think about.
Okay. Audience question, the first one. At Brian's level, I'm sure he gets inundated with a million requests at any given moment. Wanted to know any of his tips or tricks learned over the years to cut out the noise, prioritize items, etc.
Well, this is going to be a do as I say, not as I do, because if you ask anybody, this is an issue of time management. So I had there's a fellow named Mr. Storrs who was my predecessor's predecessor, came in and when I first became CEO. So he was probably low 80s at the time or mid 80s. And he came in, he sat down and he said, a lot of people are going to come into this office. Don't let them. And the idea that once there's so much demands on your time, you have to time management in his elegant way. At the end of the day, my advice is to be planful, to think about it, think about what you want to do, and then frankly turn around and look at your calendar across the last 60, 90, 120 days and say, did it happen? Now, in the COVID crisis, everything I planned to do was thrown up against the wall and disappeared. But I'll flip it. I actually have done more stuff in some ways because I haven't had to travel so much. You just don't have the time and travel that allows us to have more conversations like this. This may or may not have worked due to scheduling and everything else. So I think one is be planful about it. So therefore, and two, test it. And three, depending on your level, have somebody else objectively analyze it. So in my case, I have assistant and other teammates who make sure that I stay on track and I don't miss, so I have to need to spend time with various constituencies of the company and they make sure I have the balance. The flip to that is you have to be accessible. And so my email is in the public domain, and if you email me to the email I logged into this thing with, that's me. I read every one of them. I get hundreds and hundreds a day. I have to respond. And if they're a customer issue, they go here, the other stuff. The reason why I say that is I don't think you can run a big company that has 50 million, 60 million households or consumers dealing with that coming in without letting them have access to the top of the house. And so, Holly O'Neill, our head of customer care, her email is out there, and we want people who have issues to come, and we'll solve them. Good news is there's not that many of them. But I think the question is control your calendar, figure out where you want to spend your time, and then test against it. But the flip side is accessibility, even as you get more senior, is also critical. So how do you manage that? Is don't forget, if you get yourself removed, you're going to make a mistake.
This question's from Peter Gisela. I apologize if I'm mispronouncing. Should Congress pass more COVID-19 relief at 1, 2, or 3 trillion? Should it give aid to local or state governments? Will this happen in 2020 or 2021? How does the federal government pay this back in the future?
Well, those are all good questions. Some of which, if I could give you a guess at, but you have to. The politics of it are other people's decision. I don't think the number is as important as the point. I think the states need help. I think that there is expenditures they made. There's holes in budgets that if we don't want them to have to adjust, lay off, cut back on school funding. There's only so many things the state spends on. So if you don't want them to adjust, we better fill the hole. And basically, that's not a new idea. That is the Hamiltonian principles that Alexander Hamilton put in, where they lifted the debts of the state up after the Revolutionary War when something happened that cost the states a lot. And so the idea, people objected to it then, and people would object to it now. But the idea is that there were states that were better managed then fiscally and less managed. But the idea of doing that, I think, is helpful because then allows the states to go on about their business. Now, that's a narrow definition of helping, but I think they need to be helped. I think the other, as we talked about before, do they think they need to pass? I think the sooner they pass it, the more stability they put. Business employees people. Business drives employment growth, small, medium, large size businesses. But businesses do not like uncertainty. And anything you can do to make it more certain. Our economists now have the size of the economy crossing back over the same size before the crisis in the first quarter of 22. They and the blue chips have moved that largely in from the end of 22. That's a hugely different outcome to say we started and we finished basically within 3 quarters this year and 4, 7, 8 quarters. That's a pretty fast turnaround. And so I think the stimulus helps assure that outcome. And that's an important outcome because that means going back to that restaurant. they'll probably hang on. But if it was going to be 5 years, it may not work. If it's going to be 5 quarters or 3 or a year, you can start to see the light at the end of the tunnel. So I think to keep the confidence up, I think they need to pass it sooner.
All right, I think we have time for exactly one more.
It is, I think, it has to do with the math that they have.
Sorry.
And by the way, the paying for it, just to finish off, it's not the time to argue about the paying for it. In the future, though, we're going to have to be serious about getting the debt in line again, and that isn't the time.
There's a little bit of a lag. I don't know if I'm the only one seeing it. I'm going to go on. Brian, can you hear me?
I can hear you fine, yeah.
Okay. We have time for one final question.
Let me do something.
Not that much time. This one's from Graham Wrong. And you touched on this a little bit earlier, Brian, but could you comment on fintech versus big tech to the future of banking, and how will fintech improve financial inclusion?
Hold on a second. Let me just hold on. I think the question was, how does fintech improve financial inclusion? Can you hear me now better?
Yeah, that sounds better. And there was a first part to that too, which is if you could just comment on fintech versus big tech, which you kind of did earlier, but if you have anything.
Yeah. I think financial inclusion, it largely is around 2 elements generally. It's transactional banking, i.e. access to banking services. And I think the industry does a great job in that, and we need to do an even better job in that. So you're seeing a lot of us bring up non-overdraft accounts, which allows people to open accounts more readily. We're changing our policies about reporting people who may have had issues with their accounts and things like that. Then there's the borrowing side, and the borrowing side gets more complex because the amount of credit risk taken on by institution can threaten the institution's viability. So I think the specialized programs we have around mortgage lending, we need to do more to help drive the lending side, all in the industry, and those of us in the industry focus on this. I think small balance lending and things that went outside our industry because of the rules, I think there's been rules passed allowed to come back in. So that's the second thing, but you have to think about it both ways. And I think that we have about 3 million non-overdraft accounts now. It's safe, called a safe balance account, which basically says to somebody, you will not have any overdraft fees. You manage within your balances and things like that. Those are products and services that the industry keeps to stress to get financial inclusion. There's 2 terms that are used: unbanked and underbanked. Unbanked means there's no bank account at all. Underbanked means they have an account with us, an account with a non-traditional provider. And we need to work on the underbanked. The unbanked, there's elements that are tricky too, but the underbanked is more about the lending. And we look forward to bringing some products in over the next month or so that people, I think, and other of our competitors have brought some products in to help handle like small balance lending and temporary lending, emergency cash lending. There's all these words for it that we'll be bringing out that I think are very fair to the industry, to the clients, excuse me.
All right. Brian, it's been such a pleasure. Thank you so much for your time today.
Okay. Thank you.
Brian, this is Bill Clifford coming back on, and I want to thank you both. If I may exercise the privilege of having a final question here, because I'm so fascinated by this conversation. I hope you don't mind, Tanea. You've done a fabulous job. Brian, the Federal Reserve signaled that interest rates are going to be near zero through 2023. This is an extraordinary time of easy money in our history and for the globe. I'm wondering how this affects your bank and the banking sector. What does it mean for performance and how you strategize?
Well, one of the things, Bill, is that when you're in a business and have $1.7 trillion of deposits like we do, they're transactional deposits, the value of them is less when the loan side of the rate structure comes down. And so it squeezes our margins. And so we were at 2.3% net interest margin, the percentage difference between our lending rate and our deposit all and borrowing rate. Now we're down to about 180. Well, that's 50 basis points on 230 is a lot of profit squeeze in the potential profit squeeze. So it hurts us in the short term. The reality is the management team that I have the honor to work with here at Bank of America, we came in 10, and we've had a rate structure basically it looks like it does now, pretty much, especially on the short side, pretty much all the time since, except for 16, 17, and in 18 when they raised rates. So I think we'll manage the expenses well. We'll continue to simplify the company. We'll continue to operational excellence. That's how we'll manage the profit squeeze. The long-term ramifications, or the Fed has made clear something different, and that's what I think people should understand, is they're going to let the rate structure and the accommodation stay in longer to get the average inflation above 2%, as Chair Powell says. That is because there's been a frustration that we haven't had the robustness to the economy and inflation. So they're going to stay accommodative longer, going to your point, to 23. But I hope they're wrong. I hope they have to raise them sooner, because that means that if for the right reasons, i.e. the economy is growing and unemployment's tight, that's what you want. And so I'd argue that based on the data we see that, I might put, if we continue to see the path of the economy improving, that they may be revisiting that faster than they think, only because the economy recovery is moving in faster. But there's still a lot of uncertainty. So I think the right answer was get the rates, get accommodative, use the balance sheet, use the structures of the facilities. They've done a lot of great things for the American people, because that's who they serve. And I think they'll keep doing it as long as they have to. But there is a little bit of tilt difference that went on in this last year, which is they're pushing inflation to average above 2, as opposed to get to 2 and then they start changing rates. So it'll feel like a little longer at the low rates till the economy is even going a little faster. The inflation's going faster, and the economy inherently is probably growing faster.
Well, thank you very much for your response. You said at the outset that we are in primarily a health crisis. It's become an economic crisis, and there's so much social upheaval that is intertwined with both of those. And we will be continuing to cover these in conversations with the C-suite for the rest of the week and in World Affairs Council programming in the coming months. So please, I encourage our listeners and our watchers to support their local World Affairs Councils. Brian, I want to thank you especially because I know that you are engaged with the World Affairs Council of Charlotte, which has been trying to give you the World Citizen Award a couple times this year, but because of COVID, it's pushed into 2021. That award goes back to 1990 when Reverend Billy Graham first received it. We are delighted that you are so positive on World Affairs Councils. Tanea, thank you for engaging in this very thoughtful discussion, which has been recorded and we'll share with our members who weren't able to join. Again, everybody, I hope you'll come tomorrow. We have the Qatar Airways CEO, a last-minute addition to our conference at 11 a.m. Eastern. He will talk about the future of aviation, tourism, and travel. And at 4 p.m., we have Ambassador Charles Rivkin, who was U.S. Ambassador to France, but is also now the president of and CEO of the Motion Picture Association, joining us at 4 p.m. Eastern. Thank you very much for being part of this conference. And Brian, Tanea, thank you as well again for your work and contributions. Have a good afternoon, everybody.
Thanks, Bill.